Today, we're diving straight into an investment analysis report on Snowflake. The title is SNOWStock, 3 Reasons This Earnings Report Changes Everything.
And it argues that a recent stock sell-off completely missed a major pivot for the company, one driven by some really impressive AI monetization and a growing contract backlog.
It really does. It makes a strong case for, let's say, a big disconnect between the price and the actual value here, especially around this shift from AI just being hype to, actual revenue. The analysis report points to what it calls a game-changing stat, and that is that 50% of all new bookings in Q3 were influenced by AI.
That is a stunning figure. It's absolute gold.
Right? But the question is, how do you use that to really maximize it?
Well, that's the first point. If you really want this to hit hard, that crucial AI data, it needs to be the first thing the reader sees. It has to be the primary startling hook for the whole thesis.
Okay, I hear you. You want that immediate knockout punch. But let me just push back a little. If we lead with a number like 50%, do we risk sounding a bit, sensationalized?
How so?
Well, doesn't a high-level analysis report need to build a foundation first, like with the RPO, the remaining performance obligations, to ground that AI figure in real contract strength, just to show it's not noise?
That's a fair challenge, and I think it really comes down to who you're writing for.
Okay.
For this kind of expert analysis, you have 3 seconds, maybe 5? You have to grab their attention and prove you see something the market missed.
And the current opening doesn't do that?
No. The current opening gives all this context about the market's beat and raise reaction before it gets to the core financial breakthrough. It delays the best part.
So the weakness isn't the argument, it's the sequence.
The sequence, exactly. You're reducing the punchiness. You're not immediately validating that title changes everything.
And for a skeptical, time-crunched reader,
They might not even get to point 1 where that 50% figure is hiding. So the suggestion is really simple. Just reorient that opening paragraph. Lead with your most compelling stats.
make the conflict about AI hype versus AI revenue.
Yes, frame that as a central conflict that the market is mispricing right now. That's what justifies the whole read.
So it's less about explaining the situation and more about confronting the market's narrative, right from the first sentence. How would you do that?
You could swap the market reaction for the financial achievement. So one way is to lead with the fact that Snowflake hit a $100 million AI product revenue run rate, a full quarter ahead of schedule.
Okay, that's a hard number. It immediately establishes a real financial win.
It's tied directly to AI. Or even better, maybe just state that 50% bookings number in the first 2 sentences.
And that instantly validates the headline.
Instantly. And it establishes just how severe the market's mispricing might be before you even get into the RPO data.
The difference is huge. It really is. Opening with the run rate or that 50% stat, it makes the report a must-read from the get-go.
Exactly. You're not setting the scene anymore. You're presenting evidence of a major inflection point.
Okay, so let's assume we've established that. The next logical question for the report is whether that new revenue is actually sustainable.
Right. Is it a flash in the pan?
Which brings us to point 2. This focuses on what the report calls the hidden growth metric, which is the RPO, or remaining performance obligations. Basically, the contract backlog. And the material highlights that RPO growth surged to 37% year over year. That's huge. It's now at $7.9 billion, which is way faster than the 29% revenue growth.
And that divergence is a powerful sign. It usually signals future acceleration.
It does.
But while the quantitative argument is powerful, that RPO divergence, the analysis could be so much stronger if it explicitly showed how that acceleration is linked to these new high-value AI products.
Wait, but RPO is RPO, isn't it? It's contractually obligated revenue. If it's growing at 37%, doesn't that inherently prove commitment, whatever the product mix is?
But that's the key question for an institutional investor, because the quality of that RPO determines the multiple the market will pay.
The multiple. So you're saying not all contract backlog is created equal?
Not at all. Low-quality RPO could just be bigger commitments to existing, commoditized services. High-quality RPO, the kind that justifies a huge growth multiple, is driven by sticky, high-margin, new products.
And the report mentions the whale clients, the big spenders, over $1 million a year, grew by 29%?
Yes, showing commitment, but I see a gap.
Okay.
The connection between that big customer growth and the reason for the 37% RPO jump, it's kind of implicit.
I see what you mean. We need to be able to tell the reader, Is this RPO growth just from, say, a temporary boost in using core cloud services? Or is it from rapid, structural adoption of new AI products like Cortex AI?
You've got it. You have to answer that implied question to prove this isn't just some cyclical bump. So the suggestion is to directly weave the AI evidence from point 1 into this RPO discussion in point 2.
That makes so much sense.
It shows that the contract backlog is high quality, it's future-proof revenue. It proves Snowflake is becoming the data layer for enterprise AI.
And that integration creates a really powerful synergy, right?
The AI booking figure from point 1 is no longer just a cool stat.
It becomes the driver of the structural RPO growth in point 2. And it validates that this earnings report really does change everything. So for concrete examples, you could, maybe in the Why RPO Matters section, just state that the acceleration is a direct result of the 1,200 plus customers now using these advanced AI features.
Perfect. So it's not just that RPO is growing. It's growing because the biggest clients are signing these huge contracts specifically for the new AI platform.
Right. That closes the loop.
It does. Or you could frame that 29% growth in whale clients as a direct result of cross-selling into that new platform. You're tying the contracts to the product mix.
We're moving the discussion from a big number to a big, high-quality number.
Exactly. A crucial qualitative layer on top of a strong quantitative argument.
Okay, that feels necessary. Let's move to the last piece of the puzzle. The report has to address why the stock sold off at all.
The elephant in the room.
Yeah. So, point 3 isolates the bearish reaction as temporary noise. It cites two things: the hyperscaler outage, a clear one-off event, maybe a $1 to $2 million impact, and the free cash flow miss, which it says was due to the timing of collections.
And this section has a critical tonal problem.
Oh?
The analysis, it risks sounding defensive. By grouping a really common and serious investor concern like a free cash flow miss with a simple technical glitch, it just dilutes the authority of the whole report.
That's a fascinating point about investor psychology. Why is that specific mistake so much worse for a report targeting, say, institutional readers versus retail investors?
Because sophisticated readers are trained to see through one-time excuses. Just attributing an FCF miss to timing of collections without any more context?
It's a common defense.
It's just classic defense, and it raises immediate skepticism. FCF is a vital sign of health for a growth stock. You can't just dismiss it. The market might forgive a $2 million outage, but they will pause at any sign of cash flow weakness.
So the weakness here isn't that the explanation is wrong necessarily. It's that it lacks the proof needed to convince an expert skeptic that this is truly temporary.
Exactly. It feels like an assertion, not an analysis. So the suggestion is to give a more robust, a more structural explanation for that FCF timing issue.
Don't just mention it.
Don't just say timing. Link it explicitly back to the accelerating metrics we just talked about. Show that the cash is just delayed, not destroyed. That's how you reinforce the idea that the smart money is looking past this metric because they understand the mechanics behind it.
That creates a beautiful reinforcing loop with point 2, doesn't it? The very thing driving long-term growth, that 37% RPO acceleration, becomes the reason for the short-term cash flow anomaly.
Yes. You transform the perceived weakness into a symptom of overwhelming strength.
Okay, so give me a concrete example. How would you do that?
Well, you could briefly detail why the timing of collections was unusual this quarter. You could say, for instance, that because RPO accelerated so fast, you had a higher volume of big new contracts signed late in the quarter.
Right.
And maybe because the AI products are so new, they have non-standard payment terms, so the cash collection would logically be delayed into Q4. You're telling the reader that delay is because of rapid growth, not operational failure.
What about external validation? The report did mention raised price targets.
That's the knockout punch for this section. You have to leverage those analyst target raises. Mention RBC Capital's $300 target, KeyBank at $285, Goldman at $275.
Use them as direct third-party validation.
It's a powerful capstone. These firms looked at the exact same FCF data and they still raised their targets. It moves the argument from sounding defensive to being objectively validated.
That is incredibly powerful. You're basically telling the reader, don't just take my word for it. The smart money already did the math.
It gives them comfort. It shows them they aren't going against the herd. They're just seeing the structural strength that drove those analyst decisions in the first place.
So, stepping back, this is a fundamentally strong analysis report. It's built on solid metrics and a really timely narrative.
It absolutely is. The opportunities we identified are all about maximizing its impact and sharpening the conviction.
Okay,